Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zaegel. Tax harvesting is not something people think of a lot. And on top of that, more and more companies are automating this. Now, let's discuss if that's even a good thing or a bad thing. But first, we'll back up and talk about what tax harvesting is. Most commonly, you'll hear it talked about in terms of tax loss harvesting. We are also going to talk about tax gain harvesting, which is counterintuitive, but we'll talk about it from a planning perspective. Let's take an even further step back and give a context to what we're even talking about. So this is looking at gains or losses on investments. Therefore, we are not talking about IRA accounts, because anything that happens within an IRA account does not matter for taxes. You can buy and sell stuff in an IRA account. There's no implication whatsoever from a tax perspective. The tax happens when you take money out of the traditional IRA account. Therefore, we're talking about non-IRA accounts. They're called non-qualified accounts. So think about an individual brokerage account, trust account, a joint account with a spouse. Any of those work for this discussion, because any purchases, or really any sales, purchases can impact, there's loss rules. We're not going to go over that. So think any sale of an investment is going to have some tax impact, either a gain or a loss. And that's what we were talking about. Non-IRA accounts, when you are selling something, produce a gain or a loss. When it comes to harvesting, the most common thing we hear about is tax loss harvesting. That is where you sell an investment that is at a loss so that you can get a tax deduction on that. Now, you can get up to a $3,000 deduction per year, and you can carry that forward for as long as you need to. The carry forward doesn't really die away until you die. So a lot of times the thought is, well, if I'm sitting with an investment that has a loss towards the end of the year, especially, do I want to sell this to take the loss? That way I can have that deduction on the tax return. Now, I come along, being the tax nerd that I am, and say, well, sometimes you actually want to harvest the gain too. You may actually want to pay tax on it now if you can get it at a low or 0% tax rate. Because there is such thing as 0% capital gains if your taxable income is low enough. Not everybody fits into that. That's okay. It's just a consideration. You might actually harvest it if you're trying to offset some lost carry forwards that you have from the past. Because again, then if you're taking that gain and offsetting it against a past loss carry forward, again, it's not taxable. That gain itself is not taxable. So there are a lot of situations where you actually want to harvest gains in order to avoid taxes. Sounds counterintuitive, but if you have a lost carry forward from a previous year, you can have a gain with zero tax. Now, next step. A lot of custodians have features where they say our account handles its own tax loss harvesting, or they'll call it a tax efficient account. They'll use different terms, but essentially they'll have these accounts and you can put the money in there and it will allocate to different funds for you. And then it'll say, we are going to use our technology to be smart about taxes with this, and we're going to make it tax efficient for you in terms of harvesting essentially losses They're going to harvest losses because what they do is they assume that we don't want to pay a gain. So their idea of efficiency, which I understand what they're trying to do, it's not a bad thing what they're trying to do, but when they're automating these things, their idea of efficiency is we're going to take any losses we can and we're going to avoid any gains that we can. But as I just mentioned, sometimes you want to have gains. There are situations where you want to harvest gains. Unfortunately, these automations are not going to do that. They're not doing what I think some people think they are doing. So that you might sign up for an account and they say, hey, we're making this tax efficient. We've got our AI in there understanding which funds you're in and what's going to be taxed and what's not. But really what they're looking to do is maximize taxable losses, minimize taxable gains. A lot of times that makes sense, but not all the time. And that is the difference between having an account like that is automated and trying to do a good thing. I'm not trying to bash it, but I'm just saying you have to understand what it's trying to do. There's a difference between having this account where technology is looking at it and saying, we are going to make this tax efficient, essentially by trying to maximize taxable losses and minimize taxable gains. There's a difference between that and having planning specifically for you and your tax situation. Two very different things. Both are good or can be good, but they're not the same thing. Let's say, for example, you're an Apple shareholder and you've bought 100 shares of Apple every year for the past decade. So you have some from 10 years ago that have gone up a ton, and you have some maybe from a year ago that haven't maybe gone up a whole lot at all, and everything in between. Mostly Apple's been up, so you probably have gains throughout the decade, regardless of when you've been buying it. If the software were involved in automating this, it would say, well, we're going to sell the lowest gain that we can that is long-term. We don't necessarily want to sell the short-term capital gain because those are taxed at higher rates. We're going to say, what have we held for at least a year that has the least amount of gain? And we want to sell that sucker because that's going to be the most tax efficient. And again, for a lot of people, that is the correct answer. But it may not be the correct answer for you. And in fact, there may even be other factors involved in how we handle that investment account. For example, let's say that you tend to donate money to charities. We're going to look at this account and say, we're going to identify which lot of Apple stock you bought that actually has the highest gain and make sure to get that piece donated. Or in some cases, again, like we talked about earlier, whereas the software would say, let's take the long term, anything we've held for more than a year with the smallest amount of gain, that's what we want to sell. Well, if you have capital loss carry forwards, we may instead go back and say, we actually want to take the oldest lot that you bought from Apple, sell that, even though it has a big gain, because we're going to offset it against the capital loss that we're carrying forward. So this just highlights that you have to be a little bit careful when you're using technology and automation to do these things, because that technology and automation is really only operating on specific assumptions, as it should. It can't, an AI maybe get to the point where you can upload all your information and it can do some of this reasoning for you, perhaps. I think we're a little ways off from that, but again, that's all future maybe. But for now, any time you see an account where they're talking about tax efficiency or automated tax harvesting, just understand that it is programmed a certain way. It is programmed really to try to maximize tax losses and reduce tax gains. That may be what you need, but it may not be. And that's where you have to be careful. Most of the time, it's going to be helpful, at least helpful, sometimes very profitable, to instead be planning very specifically your investment account around what you are holding and what you're buying and selling to truly maximize and harvest either those gains or the losses to benefit you from a tax perspective, not only now, but long term. So I just wanted to bring that to you so you understand if you see an account online and it says, tax efficient account or something like that, just understand it's programmed a certain way. It's not programmed specifically for you. So you just need to understand what that technology is doing. It might not be what you actually want it to do versus planning specifically for that account and what you buy and sell in the account on an individual basis.